Picture this. It's August 1990, early morning in New York, and you're sitting behind a commodities desk watching the oil screen flicker before the U.S. market fully opens. Just 3 weeks ago, Brent crude traded calmly around $17 a barrel. Now, the number blinking on the terminal reads $36. Not gradually, not politely. The candles on the chart look almost vertical, the kind of move traders normally associate with financial panic or supply collapse. But something strange is happening. Tankers are still sailing. Refineries are still running. Pipelines haven't stopped. Yet the market is already repricing the world. Across the desk, another screen shows shipping insurance premiums for oil tankers in the Persian Gulf. In less than a month, the cost has jumped more than 300%. Airlines begin recalculating fuel budgets for the next quarter. Freight companies quietly revise transport contracts. Energy traders pick up the phone and start hedging supply months ahead. None of this is visible on the evening news yet. But inside the market, the arithmetic has already changed. Because when war appears near the arteries of global energy, the first thing that moves isn't the battlefield. It's the barrel. Wars look political on television. In markets, they become mechanical. And the oil market never waits for confirmation. It prices the risk first. Once you start looking for it, the pattern becomes impossible to ignore. Every major geopolitical shock that touches the global energy system leaves almost the same fingerprint on the oil chart. In 1973, during the Yom Kippur War, oil prices didn't simply climb, they quadrupled. In 1979, the Iranian Revolution removed only a portion of global supply, yet crude surged more than 2.5 times. In 1990, when Iraq invaded Kuwait, Brent crude doubled within weeks. Decades later, when Russia invaded Ukraine in 2022, energy markets once again erupted, sending oil prices sharply higher across continents. Different wars, different decades, the same reaction. At first glance, the explanation seems straightforward. War disrupts supply. But that story is incomplete. In several of these moments, the physical flow of oil had barely changed when the price surge began. Pipelines were still pumping. Tankers were still leaving ports. Refineries were still turning crude into gasoline, diesel, and jet fuel. Yet the market moved anyway. Because oil markets do not wait for shortages. They price the probability of disruption long before disruption becomes real. The barrel moves first. Prices jump, and the ripple spreads outward, into fuel stations, airline tickets, shipping costs, and eventually the grocery bill sitting on a kitchen table thousands of miles from the battlefield. This is how energy shocks travel through an economy. Not slowly, instantly. Once you see that mechanism, the pattern becomes clearer. Oil does not surge during war because traders panic randomly. It surges because the structure of the global energy system contains a hidden vulnerability. A pressure point most people never notice. And every major war, sooner or later, pushes directly on it. Mechanism 1. Geography shock. To understand the vulnerability, you have to zoom out and look at the map. The global energy system looks vast and complex, but structurally, it behaves more like a circulatory system. Oil fields act as the heart, pumping energy into the global economy. Tankers, pipelines, and shipping lanes act as arteries carrying that energy outward to every industrial nation on Earth. And, like any circulatory system, the problem isn't the volume of blood. It's the narrowness of the arteries. A huge share of the world's oil is produced in just a handful of regions, particularly the Middle East, parts of Russia, and a few concentrated basins that have shaped geopolitics for decades. From there, much of that energy must pass through several extremely narrow gateways. The Strait of Hormuz alone carries roughly 1/3 of all seaborne oil on Earth. Another major flow passes through the Suez Canal, connecting Middle Eastern production to Europe and beyond. On a map, these chokepoints look like thin lines between continents. In reality, they function more like pressure valves for the global economy. When the conflict appears anywhere near these corridors, the market doesn't wait for tankers to stop moving. It begins calculating risk immediately. Could insurance costs explode overnight? Could sanctions reroute cargo? Could one damaged port slow traffic for weeks? Because when so much energy moves through so few passages, even a small disruption can echo through the entire system. Fuel costs shift. Shipping costs climb. Inflation begins to stir. The barrels might still be flowing today, but the market is already staring at the arteries and asking how easily one of them could tighten. Mechanism 2. The transport choke point effect. Once geography concentrates the flow of oil, the next layer of vulnerability appears in something even simpler: movement. Oil is not valuable where it is produced. It becomes valuable when it moves. A barrel sitting underground in the Persian Gulf does nothing for a refinery in Japan, a power plant in Europe, or a fleet of trucks moving food across North America. The entire global economy quietly depends on a simple assumption: that oil can travel thousands of miles across oceans and pipelines without interruption. The system runs on flow. War disrupts that flow long before supply disappears. The moment conflict touches a major shipping corridor, the transport system begins to tighten. Insurance companies recalculate risk. Shipping firms reassess routes. Ports increase inspections. Naval escorts appear. None of this stops the oil immediately, but every step introduces friction. Routes reroute. Insurance surges. Risk compounds. During the 1980s tanker war in the Persian Gulf, oil tankers suddenly became potential military targets. Insurance premiums exploded. Some vessels detoured around danger zones. Others waited for naval protection before entering the contested waters. The oil still existed, but moving it had become more dangerous and more expensive, and markets price that danger instantly. Because energy is not just produced, it is transported. And when transport becomes uncertain, the effects don't stay in the shipping lanes. They travel outward, into fuel prices, airline tickets, freight costs, and eventually the price of goods on store shelves. The barrels may still be underground, but the route to the global economy has already become fragile. Mechanism 3. Strategic hoarding. Once transport becomes uncertain, a second force quietly enters the system, and this one doesn't come from the battlefield. It comes from behavior. Because when governments and corporations sense instability in the energy system, they begin preparing for the possibility that tomorrow's oil might be harder to secure than today's. And the simplest way to prepare is not to produce more. It is to store more. Countries begin building buffers. The United States maintains the Strategic Petroleum Reserve, capable of holding hundreds of millions of barrels for emergencies. China has spent years expanding its own national stockpiles. Across Europe and Asia, governments maintain mandatory reserves designed to cushion sudden disruptions. But the hoarding doesn't stop at governments. Airlines hedge fuel contracts months in advance. Refineries increase inventory levels. Energy traders secure cargoes earlier than usual. Everyone in the system begins quietly reaching for the same insurance policy: extra barrels. And suddenly, demand behaves differently. Not because people are driving more, not because factories are producing more, but because the system is protecting itself. Inventories rise. Competition for supply intensifies. Prices climb. The oil market understands what's happening. When uncertainty spreads through the energy system, every participant tries to move first. And when millions of barrels are quietly pulled into storage all at once, the market begins to feel something else entirely: a tightening. At this point, the system reveals something deeply counterintuitive. Oil prices do not spike when the world actually runs out of oil. They spike when the world fears it might. During the 1990 Gulf War, the physical loss of global oil supply was estimated at roughly 4 to 5%. That is not insignificant, but it was far from catastrophic. Yet oil prices didn't rise by 5%. They doubled. The reaction looked irrational until you understand what the market was really pricing. Oil traders were not reacting to barrels already missing from the system. They were reacting to the possibility that far more barrels could disappear tomorrow. And probability spreads faster than reality. Once the risk of disruption enters the system, every refinery, airline, and shipping firm begins adjusting expectations at the same time. Oil markets don't trade what is. They trade what might happen next. And when uncertainty enters the bloodstream of the energy system, The repricing can move far faster than the physical shortage itself. Mechanism 4. Financial amplification. Once risk enters the oil market, the next force that accelerates the move is not geography, and it's not shipping. It's capital. Modern oil prices are not determined only by producers and refiners. They are also shaped by an enormous financial ecosystem. Hedge funds, commodity traders, pension funds, and institutional investors moving billions through futures markets every day. Oil is not just a physical commodity anymore. It is a financial asset. And when geopolitical risk appears, capital reacts quickly. Energy funds increase exposure. Commodity index funds rebalance. Hedge funds begin positioning for volatility. None of these investors are waiting for a tanker to be sunk or a pipeline to explode. They are responding to the same probability the physical market is already pricing. Money moves toward the pressure. Positions build. Liquidity surges. Momentum accelerates. The price of oil begins climbing faster than the physical system alone would justify. And the consequences don't stay inside trading screens. As oil prices climb, the cost of moving goods rises. Airlines adjust fares. Shipping contracts become more expensive. Slowly, almost invisibly, the price of energy begins working its way into the broader economy, and the ripple continues outward. Mechanism 5. Inflation transmission. And this is where the oil shock finally leaves the trading floor and enters everyday life. Because oil is not just another commodity. It sits underneath almost every movement in the modern economy. Trucks burn diesel to deliver food. Ships carry containers across oceans. Planes move passengers and cargo between continents. Factories rely on energy to run machinery and transport materials. When the price of oil rises, the system absorbs it first. Then it passes it on. Freight becomes more expensive. Airline tickets climb. Food transportation costs increase. And eventually, the ripple reaches the places people notice most: gas stations, grocery stores, and household budgets. Economists call this transmission, but on a kitchen table scale, it feels simpler. Energy gets more expensive, and suddenly everything else does too. This is why oil shocks during war travel far beyond the battlefield. A conflict in one region can quietly reshape the cost of living on the other side of the world. Because when the barrel reprices, the entire economic system begins adjusting around it. Now widen the frame and shift to the present. Today's energy system still runs through many of the same narrow corridors. Tankers continue to pass through the Strait of Hormuz. Cargo still flows through the Red Sea and the Suez Canal. A significant share of global oil and gas still originates from regions that sit close to geopolitical fault lines. The map hasn't changed much, which means the structure hasn't changed either. Energy traders watch the same indicators every time tensions rise: shipping routes, spare production capacity, strategic reserves, and insurance costs on tanker traffic. Because these numbers reveal something deeper than daily headlines. They reveal how tight the system really is. And when supply routes concentrate through a few fragile corridors, the entire global economy becomes sensitive to shocks that appear far away from most consumers. Different year, different conflict, the same arithmetic quietly running underneath the energy system, and the same question beginning to surface again. How stable is a system that depends on so few arteries to keep the world moving? Step back and look at the sequence again. War appears near the arteries of energy. Geography concentrates risk. Transport becomes uncertain. Inventories quietly expand. Financial capital amplifies the move. And the cost of energy begins spreading through the entire economy. Not slowly, systemically. The oil market reacts first because oil sits underneath everything else. When the barrel reprices, it changes the arithmetic of transportation, manufacturing, and food distribution all at once. What begins as a geopolitical shock eventually becomes something far more familiar: inflation, higher fuel costs, and a rising cost of living. That's why every major war seems to push oil higher. Not because traders panic, not because supply disappears overnight, but because the structure of the global energy system forces the market to reprice risk long before the shortage arrives. And the arithmetic always moves first.